Today, we assess the European credit market through the lens of national uncertainty, which is a situation where past data and traditional models are no longer applicable to predict future risks. So recent geopolitical tensions and energy shocks have pushed markets towards this type of environment of uncertainty. Now, to look at how investors are reacting, we're going to look at two key elements, the first one being credit spreads and the second, regional policy. So this week's clear signal came from the auction for the Bund, which has traditionally been seen as the safest asset in Europe. However, the auction signaled that it has been met with weak demand with a bid to cover ratio of 1.2, and most importantly, the German Treasury has been forced to retain 24% of the issuance, which means that that exact number has not been absorbed by the market. At the same time, the Italian government also issued an auction for the PTB, short for Buoni del Tesoro Poliennale, and it has been met with unexpectedly higher demand with a bid to cover ratio of 1.5 and oversubscription, which is unusual as Italy has always been associated as being a periphery. So these signals suggest that investors are now reassessing how risk is being priced in the Eurozone. A partial reason why the Bund has been met with weak demand could be explained by Germany's economy. The industrial output has been declining by 1.2% year on year prior to the crisis. It's also important to note that Germany's industry is energy intensive, so the energy shocks have just worsened pre-existing conditions. So analysts have slashed the forecasted growth from 1% to 0.8% and potentially 0.6% if energy shocks keeps persisting. As a result, investors are reallocating their capital towards safer alternatives, such as the European Commission bond, which has higher yields, but they're actually safer than the Bund. And the second being US dollar assets, for three key reasons. The first one being that the US industry is less energy intensive. The second reason being that they produce large amounts of oil. So it means that the US economy is more resilient during energy shocks. The third and most important reason is that the global oil is largely traded through US dollars. So it means that there's a higher demand for the US dollars, which can be seen through the euro and US dollar cross-currency basis, which has been going towards the negatives. In conclusion, the European market has entered a nation uncertainty era where traditional safe assets are no longer the safe assets, which can be seen with Germany gradually losing its title as the core economy of Europe, as the demand has been growing weaker for their bonds. And the funds have been reallocated towards the European Commission bonds and US assets.